For so many small business owners, just hearing three little letters can cause instant anxiety. CRA, the Canada Revenue Agency. I'm sure a lot of you know that feeling. But what if I told you that dealing with them doesn't have to be a source of stress? It really all comes down to your approach. And today, we're going to crack the code on how to stay compliant and, way more importantly, get some of that peace of mind back.
All right, let's just jump right in with a big one, something that gets right to the heart of it all. What do you think is that single biggest red flag for the CRA? What's the one thing that makes them go, maybe we should take a closer look at this business?
And there you have it, plain and simple. It's not some super complex, shady tax strategy. No, more often than not, it's just about being on time. To the CRA, filing late signals disorganization, and that immediately makes them wonder, well, what else is disorganized here? It's like you're literally sending them an open invitation to start asking questions. Mastering this one simple habit can change your whole world.
And this really gets to the core theme of our explainer today. When it comes to your taxes and compliance, you really only have two choices. You can be reactive, which, let's be honest, means living with stress, fear, and that awful last-minute panic. Or you can choose to be proactive, taking control, operating with clarity, and building a business that's truly resilient. So let's explore that proactive path together. Okay, so how do we actually do that? How do we get on that proactive path? Well, it all starts with a rock-solid foundation. Look, this stuff might not be the most glamorous part of running a business, I get it, but it is absolutely 100% non-negotiable for long-term success and a stress-free relationship with the CRA. We can really break this foundation down into two main pillars. First up, just mastering your filing obligations. And number two, creating a system for totally bulletproof bookkeeping. Nail these two things, and trust me, you are already miles ahead of the game. So, flawless filing. What does that actually mean? It means you have to know your calendar, inside and out. Yeah, we're talking about your main income tax returns, of course, but it's also your GST or HST filings, all those payroll remittances and slips like T4s, and even your corporate annual returns. Each one has its own deadline, and missing just one can trigger that scrutiny we're trying so hard to avoid. Okay, listen up, because this one is the golden rule. It is so important. Let's say cash flow is tight and you know you owe money, but you just can't pay the full amount right now. What do? You must still file on time. Why? Because the CRA has totally separate penalties for filing late and for paying late. Filing on time shows you're acting in good faith, it stops that nasty late filing penalty in its tracks, and it opens the door to arranging a payment plan. If you ignore it, things get so much worse, so much faster. All right, next let's talk bulletproof bookkeeping. This is all about having clean, traceable records. The easiest first step, get separate bank accounts and credit cards for business and personal. Seriously, no exceptions. From there, it's just about simple habits. Reconcile those accounts every single month. Keep a digital copy of every single receipt, and be specific. And that miscellaneous category, just get rid of it. To an auditor, it just looks like you're trying to hide stuff. So you've got these perfect records. How long do you have to hang on to them? The magic number you need to burn into your brain is 6. 6 years. The CRA can go back a full 6 years to ask for your records. So that digital filing system needs to be organized and accessible for at least that long. Think of it as your 6-year-long safety net. Okay, so our foundation is solid. Now let's move up a level and talk about mastering the money flow, the cash coming in and the cash going out of your business. This is where the CRA is really looking for consistency and, maybe most importantly, reasonableness. Mastering your money flow really just comes down to two sides of the very same coin. On one side, you have to report every single dollar that comes in, accurately. And on the other, you have to be ready to justify every single expense you claim as a deduction. When it comes to income, the key word is completeness. And I mean all of it. Cash, e-transfers. If you got paid, it counts. And the CRA is not just taking your word for it. They're looking at the sales numbers you put on your GST/HST returns, and they're comparing that to the data they get from payment processors like Shopify or Stripe. If all those numbers don't line up and tell the exact same story, you can bet you'll be getting a letter in the mail.
And this is really the reality of taxes today, right? The CRA has access to a ton of data, and their computer systems are literally built to cross-reference everything automatically. So being consistent across all your different reporting platforms isn't just a good idea, it's a non-negotiable.
Okay, let's switch over to expenses.
Here's a great example of a rule that trips a lot of people up. Taking a client out for lunch or to a hockey game? Absolutely a legitimate business expense. But here's the catch. You can only claim 50% of that cost. It's knowing these little, specific, sometimes kind of quirky rules that keeps your return from raising any red flags.
The big overarching rule for expenses is actually pretty simple. Can you prove this cost was made to help you earn business income? If the answer is yes, you can probably claim it. But the key word in all of this is prove. For your car, that means a logbook tracking business versus personal kilometers. For your home office, it means having a clear written down calculation of the space you use only for business. Your documentation is your defense. It's that simple.
And you know, this might be the single best piece of advice I can give you. A little gut check. You know when you're thinking about claiming something and that little voice in the back of your head pipes up and asks, Can I really get away with this? Well, that's your answer right there. The CRA values reasonableness above all. Aggressive or questionable claims are exactly what gets their attention.
All right, so we've got our foundation set. We've mastered the money flow. Now for our last section, let's navigate some of the nitty-gritty details where, honestly, a lot of businesses get tripped up. Getting these details right is the mark of a truly proactive business owner.
We're going to focus on three key things here. First, GST and HST compliance, which is often the very first place the CRA spots a problem. Second, how you pay yourself as the owner, which says a lot about your financial discipline. And finally, and this one's huge, the critical skill of just communicating with the CRA. So GST and HST, the CRA thinks of this as trust money. Basically, you're just holding on to it for the government, so you can bet they take it very seriously. You've got to register when your revenue hits the threshold, you must file your returns consistently, and if you want to claim back the GST you paid on your expenses, what they call input tax credits, you better have a proper invoice to prove it. No invoice, no credit. End of story. This slide just lays it out so perfectly, the two paths for paying yourself as an owner. You've got the reactive way, which is just yanking money out of the business account whenever you feel like it. That is a massive red flag. The CRA literally calls this using your business as your personal piggy bank. Then you've got the proactive way, a planned salary or declared dividends with all the proper paperwork. One is clean, it's professional, it's defensible. The other is just messy and it's basically asking for trouble. Okay, if you take away only one thing from our chat today, please let it be this. You know that brown envelope from the CRA that shows up in your mailbox? Your first instinct might be to just put it on the counter and ignore it. Do not do that. Open it right away. Burying your head in the sand is the absolute worst strategy. Responding on time, even if it's just to ask for more time, shows you're engaged and responsible. Ignoring it makes the problem bigger every single time. So we've walked through all the steps, the rules, the foundations, but why are we doing all this? What's the real point? It's not just about avoiding an audit. It's about the real payoff for you as a business owner. And you know, for a lot of us, the final piece of this puzzle is finding the right partner. A proactive accountant isn't someone you just see once a year to file old paperwork. They're not a historian. They're a co-pilot, looking ahead. They're checking in on your numbers every quarter, helping you fix issues before they become real problems, and talking to you about planning for the future, not just reporting on the past. Honestly, think of it as an investment in your own peace of mind. And that really brings us full circle, right back to where we started, with a final question for you. I want you to really think about your own habits, your own systems. Is your business built for that constant reaction, that stress? Or is it built to give you clarity, to give you control, and, most importantly, to give you that peace of mind that you absolutely deserve for all your hard work? The choice? It's all yours.